Hello, everyone. Great to have you here with me. I'm Jan Muta, the Chief Market Analyst for TO Markets. And today's topic is how do we understand candlestick momentum? It's basically the aim is to get better trades and make better trades with better understanding of momentum analysis. And we're going to stick with candlesticks today. Sorry, the pun. But basically, we want to understand better if there is something more in the price action that can help us to identify good trades. So great to have you here. And before we do anything else, I just have to remind you that we basically don't provide any investment advice. This is only for educational and marketing purposes. Now, in this webinar, I will help you to understand how to read candlesticks charts, to understand the momentum patterns in candlesticks, and then to understand the context in which the patterns occur. And this will help you to identify the momentum better so that you can time your trades better. I need to remind you guys, if you're watching this on YouTube afterwards, please subscribe on this channel and switch on the notification so that you know when we have new videos produced, so that you get to see them straight away. Here's a little bit on my background. It probably helps you to understand where I come from and maybe gives you some reasons why you should listen to me. I started in 1998. I was trading for a hedge fund in London. We traded futures and American stocks. And basically, ever since then, I've been hooked. I've been working in this industry, both on the retail side and the institutional side. And I have been monitoring, analyzing, and trading the markets for over 20 years now. So I really do know what I'm talking about. And I know that I can help you. So stick to this, stay around, stick to this webinar, whether you're watching it live or afterwards. And also, if you have any questions, you can always email me. Just send your email to support@tomarkets.com. support@tomarkets.com. And they'll forward those emails to me, and I make sure I'll reply to your questions. Or if I don't have time, then I'll reply to your questions in the next webinar. All right, so you might want to go to tomarkets.com/analysis, because there you can get my daily analysis. And this is highly important because this allows me to communicate to you what I'm seeing in the marketplace. If I see a market setting up and I think there's a trade opportunity there, I will tell you. And if you follow this analysis on daily basis, you will understand why and how a lot of the concepts that we are talking today about, why they work, how they work, and you can learn how to use those in your trading. As always, I don't know what's going to happen in the future, so I can't possibly be right with my market analysis every time. But over the time, if you use proper risk management, I'm sure you'll come ahead if you just follow the principles that I give you in the webinars and then follow the analysis. And then obviously you make your own trading decisions. Somebody might take only 5 pips and somebody other might take 50 pips or 35 pips using the same setup. Those are the choices that you make, but I'm pointing you to the right direction. And as you follow my analysis there, you learn more and more day by day. And okay, this is something that I also have to touch before we go into the meat of this today's topic. So basically, I need to help you to get ready for trading. Go first to tomarkets.com/register. There you can fill in your details and we will email account credentials to you. Then you get an access to your client space, your personal client space. And there you can go and deposit to your account. There's loads more options, but you can use wire transfer, you can use Visa, but if you have any questions on some alternative ways of doing this, just go and just send an email to support@tiomarkets.com or ask our people when they call you after registration. They will help you also. We have a lovely support team. They are so very helpful and will help you through the process. Then go to the download center and download the MT4 or MT5 platform. I prefer MT5, but it's up to you really. And then go and open both live and demo accounts. Here you can see live account and demo account. The account opening processes are exactly the same. You just open account and then you get another email. Then there you have the credentials, which you have to put into the MetaTrader platform in order to connect the platform with the account. But if you do that, I'll be very happy, and I'll be happy to help you to trade your account. All right. Now, let's move into reading the candlesticks. I'm going to go through some basics first so that you understand what we're talking about. And you might already know this, but there's always new people watching the video or joining the webinar, so it's worth going through these. But I promise you, I don't spend too much time on these because these are very simple things at the end of the day. Now, the most common chart types are bar chart, line chart, and candlesticks. So basically, they all record roughly the same things. Line chart or line on close records only the closing prices. And then you have a bar chart where the closing prices are marked with these little horizontal bars on the right-hand side of the vertical bar. And there on the left-hand side, there's a little horizontal bar that signifies the opening price. So the open and close. Now, in candlesticks, you have a body. So basically, this chart and this, they're very similar, but candlestick is more visual. And let's go and see a little bit more in detail. What can we understand the charts? Why, the reason why candlesticks is so popular is that it's so visual. It's easy to read. It's kind of difficult to read the bar charts. When I started trading, it was almost all the charts were either bar or line charts. Since then, candlesticks have taken over. Okay, so how do you read these? First of all, we have the body. In every candlestick, we have a body. And basically, it gives you the distance between the open and close. Here, for instance, we have a green candle where the open is down here. Our close is up there. So the body gives you the distance between the open and the close. And as you can see, this was a momentum candle. Lots of momentum there. Then the price action was still positive, still bullish, but there was less distance between the open and closing price. Then there were a couple of candles where you had roughly no change, a little push higher, and then a red candle where the open of the candle is where the upper end of the body is, and the lower end of the body is where the candle closed. So because of different coloring here, you can quickly see that, okay, the market was moving there higher, and then it reacted lower. And then comes another push higher, big momentum bar. So when you have these big candles in the market, especially in, say, we're looking at the context of an uptrend, and you have a big candle like this one and this one there, then you know that the bulls are really outnumbering the bears. So in other words, the bears really don't want to be sellers at these prices here. They wait for higher prices to sell, and the bulls are very happy to buy. So the market moves higher. Then we get momentum candles to the downside. And now it's the opposite. Now the bulls aren't so happy to buy, so the market is moving lower. But there's so much more to it, so let's move on. And again, if you have any questions, please ask the questions. And I'm keeping my eye on the chat window, hoping that there'll be a question for me. So please do that. Let me know you are there. Because at the end of the day, this is interactive. I'm here for you guys. You can watch videos anytime you like. But these are special times for you and me to come together on studying this topic and then really discussing and understanding what's going on. Does it make sense this far? Let me know if this is really, really simple for you. If you already know this stuff and you don't have to really bother yourself with this. If you've been trading years and years, you might know this already. Just let me know actually how many years you've been trading. Type in the number of years in the chat box, and that helps me to understand where you are in terms of your learning curve. Okay, let's study the patterns a little bit. Here we have, if you go to the internet and do a search on candlestick patterns, there's loads of stuff. There's so many different candlestick patterns with all the different funny names. And I tell you, it really is, most of it is rubbish. Hopefully you don't mind me saying this so straight, but at the end of the day, most of that stuff is rubbish. Over the 20 years, I haven't seen a way to use all these patterns reliably. They really don't add value. It's the simple things that add value. Momentum, support and resistance. And that's really, actually, that's the most important two things. Support, resistance levels, and momentum. If you understand those, you'll do fine. And what we are going to learn today will help you to understand this stuff. So I'm not going to spend time on these. I'm going to really concentrate only on these: bullish and bearish engulfing, hammers and shooting stars, inside bars. Those, if you understand those, and then use these in the context of support and resistance and the trends, then you'll do fine. Okay, first of all, bullish and bearish engulfing. What do we mean by those? First of all, down here, we have market trending, kind of drifting lower, really. And then comes a moment where we have a candle that has bigger range than this and quite a few of the previous candles. So this candle engulfs those candles there. That's why it's called bullish engulfing, because it's rallying higher. It's rallying higher from support, and it's greater. It has a greater range than the previous candles. So what does it mean in practice? What does it mean in practice? We basically have down here market pushing a little bit lower, then the move is rejected, and then something really positive happens. Maybe there's a flood of new buy orders into the market. There could be just a technical rally going on, or there could be some fundamental reasons why the market moves like this. We never know for sure. Or most of the time we don't know for sure. But what's enough is that the market is rallying higher, probably from a support, and then we get some sideways movement and then another push higher. So basically, bullish engulfing candle signifies just that. There's much more demand here than there was during the previous candles. First of all, the market was making lower lows, lower highs. It was just drifting lower. And then comes this big push higher. All the supply that there was is absorbed by the bulls. Then the market creates higher lows. Again, another bullish sign. And then there's another explosion to the upside. Then the bearish engulfing. But before I do that, let me check what you answered me. Peter's been trading for 1 year, Luke for 3 years of active trading, Soon for 3 years, and a lot of, yeah, I agree with you. There's a lot of fake breakout signals. Okay, we can talk about fake breakout signals. I really don't. First of all, now that we are at this topic here, let me just mention, I really don't like breakouts myself. They are really difficult to trade. But sometimes that's the only option you have. But yeah, we can study how the prices move in these breakout situations. We don't have the time to do a big study now, but I'm just saying to you, Luke, sorry, this was Soon. Soon, please look at the historical prices. If you see a breakout in 4-hour time frame or hourly time frame, go to 10-minute chart and see how the price is moving around those support and resistance levels. If you have an upside breakout, i.e. market breaking above a resistance, and then the market just fluctuates around the level, the resistance level, then you know that this might not be a very strong breakout, and you might have to look for smaller levels in, say, for instance, 10-minute chart. If the market moves below the resistance and then starts to create higher lows in the 10-minute chart, then that could be a sign that yes, there's buying coming into the market. Yeah, but trading breakouts is a little tough. All right, so here we are. We have a bearish engulfing here. The market has been moving higher, and then comes a reversal. Bearish engulfing, just like bullish engulfing here, they are reversal signals. And when the market comes to a resistance and reacts like this, you have a spike higher. The range of this candle is bigger than the previous candle's range. So the previous candle is engulfed by this big engulfing candle. That's a signal that the bulls aren't in charge anymore. There is supply coming into the market. And then the market creates a momentum candle to the downside. Suleiman is saying reversal pattern remain for how much time after the bullish or bearish engulfing pattern? I don't really quite catch what you're saying there. Can you kind of rephrase your question a little bit? Maybe I then get an idea what you're saying. Reversal pattern remains. Okay, I'd be sorry. I'm really sorry, but I don't understand the question. Can you rephrase it? And let's see if I can get what you're saying there. But yeah, you're right, Suleiman. These are reversal patterns. And if these happen in, say, 4-hour time frame, they are pretty significant. So I'm suggesting to you, instead of going to very nitty-gritty time frames like 1 minute, 5 minute, etc., look at the big time frames like 2 hours, 4 hours, and then you have much more reliable signals for the market. Okay, then hammers and shooting stars. Here we have the price coming lower. We have some momentum candles there. And then we get these sideways candles, basically telling you that there was some imbalance with supply and demand, but now there's balance between these lows here and these highs. You have a balance. Inside this range, you have supply and demand roughly in balance, so the market isn't going anywhere. But then we start getting these. There we have a hammer candle, then another hammer candle, and they both take place in this context. So eventually this leads to market reversing to the upside. It's basically, this is one big reversal process here. First of all, you have downside momentum, then the downside momentum dies, and then you have signals that the market really wants to take off. So that's what the hammers are good for. Then the shooting stars. Here we have some upside momentum. Then comes a push above this candle's high. But what happens? There's more supply there than there is demand. More supply than demand, and the only thing that can happen is that the price moves lower when you have more supply than demand. Then comes a move lower, and then more sideways movement in this case. So we really can't know what's happening after these signals, other than that they are likely to create movement to the opposite direction than the market moved before. Here we had 3 bullish bars and then a bearish candle, signifying that there's likely to be movement to the downside. Okay, the market moved a little bit to the downside, but then started moving sideways. So this is what I'm saying. You can't really know exactly what's going to happen. Okay, the market moved lower eventually, but for quite some time it was just moving sideways. By the way, it's quite interesting that we are studying this stuff now, just today, because tonight is the FOMC press conference, and you might be able to use these basically what you learn here, you might be able to use this in today's trading. Oh yeah, patience. James is pointing out that patience is what you need. And always in trading, just be patient. I make my biggest mistakes when I try to be active when I shouldn't. And that's something I need to learn away from. And one of the ways to do that is to forget the smaller time frame charts and stick to the higher time frames. Then inside bars. Here we have the market moving higher. Nice bull run higher. Then this candle where the distance between the open and close is quite small. After this, see, there was the first candle of hesitation. Okay, that move or sideways move inside that candle was resolved to the upside. Then the market again starts to lose momentum, and then comes an inside bar. It works as a reversal signal here, and then the market moves lower. We have momentum moves to the downside, and then again we have these inside bars. See how the inside bar is signaling you that this move is probably over. So you might want to take profits here. And the market, yes, it rallies, Then the market rallies higher for one candle. Can't move higher. Keeps on ranging, and then we get some more price action. But the message here is that inside bar tells you that the previous down move is over. Here the inside bar tells you that the previous upside move is over. And these signals work the best when you see them in support and resistance levels. Okay, candlestick momentum analysis. We have learned quite a few different things here already, and like I said, this is not difficult. Here I have a chart with a few things going on. First of all, the market found support here at 32,672. This is a Dow Jones Industrial Average CFD chart. Then the price comes back to that level, and there is a sideways move. Then we get a momentum candle. So this is where the price move really gets going. That's your signal that the bulls really are not controlling this market. The market is likely to move lower. Momentum candle followed by another momentum candle. And then we have 2 more candles to the downside. But then the bulls try to stage a rally, fail, and we get another momentum candle. Then we have loss of momentum for a little while, but then yet another momentum candle. And if you just look for something similar, because you really have a strong downside movement here. If you look for these opportunities where you have momentum candles telling you that the market is likely to move to the downside, if you look for trading signals after these momentum candles, then you should be doing okay. I mean, trading signals to go short. Look for short signals when you have a similar context. If you see loss of momentum, you need to pause a little while because the market might rally higher, move up there, maybe sell off then. That would be a different game. But now we have market moving lower, kind of flag formation, breakout from this flag formation here, and then more downside. So in this context, a big candle like this signals lower prices. But then eventually what happens is that you get a big candle to the downside, but there's a support level. It's not drawn here, but quite often this is what happens. You get a big move to the downside and there's support level, and then you start getting these inside candles, and that's a momentum shift. The previous momentum here is over now because the market is not really making any new lows anymore. It's just drifting sideways. Let me see. Luke has a question. Is there a way you prefer to combine moving averages or stochastics with a bullish engulfing candle, or maybe another price pattern? It's a good question. My honest answer is that I like to create kind of combination of things. I want to look at a combination of things. So this can basically include anything from moving averages to support and resistance to candle momentum. And then once you have, we have to make one distinction here, because you're specifically asking about moving averages and stochastics. And the distinction is that whatever the price does is the leading indicator. And moving averages and stochastics, they are lagging indicators. So for me, moving averages and stochastics both work as a highlight. So I can either program my computer to give me a ding or a sound alert when stochastics goes to overbought areas in downtrend, or I can just browse through the charts and see that, okay, now we have stochastics in this downtrend context above certain level, above 80, for instance. So signaling that we might now have a move lower. And then I start to look for price action based signals to kind of validate that condition that was highlighted by the stochastics. So if the price starts to roll over, then I know that stochastics will follow. So that's really the way I use those. But yeah, let's move on. I have some charts coming on later very soon, so we can basically take a look at this aspect too. Yeah, actually, this is the time to go into the charts. Let me grab something to drink and I'll open up the charts for you guys. Okay, here we go. Let's start with gold. Gold is a market that everybody loves to trade, so it seems. I notice that whenever I write about gold, there's more views on my analysis articles, and why not? It's a market that moves. When it moves, it really does move quite a bit. So let's look at gold and candlestick momentum analysis in gold. And probably this will help me to answer your question, because I have Luke's question, because I have this chart with the usual indicators here. Okay, so what do you guys see here? What do we have here? Please let me know. Now you should know. By this time in this presentation, you have seen quite a bit of examples of candlesticks already. So what are these? Just type in the chat box. And there's a bit of delay before I get your answers. So while I wait for those, I'm going to move on and ask you to also comment on this. What do you see here? I just want to see if you've been listening to me. Okay, so, oh yeah, very good, soon, thank you. This is an engulfing candle, but it's also momentum candle. So we have a couple of things going on there. The market really rallies higher. And then we have a shooting star soon, thank you, excellent. Yeah, Peter, very good. Both of you guys are really spot on with this. We have momentum building up here. See, if you go to the left, the market rallied a bit, but then failed. Market rallied quite weakly and failed. But now we have 1, 2, 3 big candles. This has lots of wicks there, but it basically was followed by another bull candle. So we have 3 candles that point to higher prices, then a little bit of hesitancy, a little bit of, the market wasn't quite sure whether it wants to push higher. Then the bulls put in another set of green candles. And the last one is going to be what happens here. Actually, tell me what's happening here. Why did the market create a candle like this? First of all, we have buying, 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 hesitation, buying, buying, and then this. What is it signaling to you? Is it telling you that there is lots of momentum here, lots of buying going on? Should we expect for higher prices? Or is it perhaps that the market participants are selling off what they bought here? They were buying here and now they were selling. So that was a quick move. People were taking profits, and the market created a shooting star. Now that led to quite a bit of sideways movement, because this is a 4-hour chart. So that's like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17 candles of market moving nowhere. So sometimes it really pays to look at these candles and maybe exit your long positions there, because you'll get other opportunities to go long. Then what's happening here is that the market creates a support. Obviously, this momentum to the upside attracted some buying there. So we have a support level. There's a first point of touch, the second, and then the third. And then what happens? We get a bullish signal right off from the support, followed by a momentum candle, which actually is a very good signal. And these are 4-hour candles. So to have a move like this, that's That's, let's see, from the support, that's about 1.2%. Now, actually, if we go from the bottom up, 1.26%. So that's a significant move. And that leads to a strong trend higher. So we have an uptrend there. Soon is saying, after the shooting star, the market losing momentum, and then the price moves higher again. Yeah, that's the market for you. Nothing that we study here is going to be picture perfect every time. But what you see here is that people had lots of participation here in the market. Price was pushed higher, and then clearly they took profits. Then it took quite some time for the market to realize that, okay, the bears are not able to push the price below 1713, below this support. So the likely, if we go here, let's do this. So we basically don't see the latest candle here yet. Support. Okay, that tells you that the market, or that tells everybody looking at the price here at the time, that people want to buy at 1713.31. So the probabilities are that the market is reversing. Downside move, then move higher. So this could be a reversal of the previous downtrend. Then this level that market found support was a resistance there, support here. So people obviously pay a lot of attention to this level. We have the faster moving average, 20 period, moving above the slower period of 50, another sign of reversal. So that makes people thinking that, okay, maybe the market moves higher. Then we have the stochastics oscillator here making a higher low, suggesting that the market might move higher. So eventually what happens is that we get this combination of hammer candle, bullish hammer candle, and then a move higher. Okay, how do you determine your targets, 1 and 2, or alternative scenarios for the analysis? Obviously, there's lots of different situations in the markets, and there is no one simple way of doing this. I sometimes use the higher time frame supports and resistances, and sometimes I use, for instance, projections. I'm going to give you an example of a projection here. So here we have price inside a range, really. So that's the high of the range, that's the low of the range. And if the market breaks to the upside and you measure the range, this is just classical measured move analysis, you get a range like this, or the target like this. So that could be your upside target. And this time, actually, again, it worked. Quite often these do work, so you should pay attention to them. The market found it a little difficult to move above that level there. That's 1767 spot 55. Eventually, the market moved higher, but for some time, it was difficult to penetrate that level. So it tells you that quite a few people were doing the same. Quite a few people were actually looking to take profits there, because the market can't slow down unless there is supply. Okay, then alternative scenario here, because we don't provide investment advice, we always have to provide you guys with 2 scenarios. So, and it's not only the regulatory reason, that another reason is that it makes good sense. because if you in your mind get married to one direction, one solution for this sideways move here, then you might want to force the market. It's silly, but sometimes we do that as traders. Say, for instance, that the market breaks to the downside and we keep on buying even though the support didn't hold. Our reason to buy was that, okay, one, we have momentum to the upside, and then we have a support that attracts buyers. If one of those reasons is gone, then the probabilities of market moving higher are obviously smaller. If the price moves down here, then it's probably going to move somewhere down to these lows. So alternative scenario would be here that the market, let me see, that the market moves down to levels close to the recent low. Another measured move projection. But obviously not all the situations that I've write about are similar to these. So this is just a specific example that I would use in a situation like this. Edward, does it help you? Does this answer your question? If you have any further questions, I'd be happy to answer and maybe help you out. Meanwhile, you might be typing meanwhile Edward types his question, if he likes to. We can move on, and I think we should look at DAX, for instance. Okay, so this is actually a similar setup that we saw. Okay, Edward is saying yes, thank you. I'm very happy I was able to help you there. And in the future, if you have any more questions, email me. You can email at on support@tiomarkets.com. All right. So here we have DAX. Something similar is going on. The market has been trending lower. Then it starts to create higher lows. The fast moving average crosses above the slow. And let's see where the support and resistances are. Here we have one level that was a resistance. And this is very close to this one. So maybe one line is enough there. And then on the downside, the support's there. So it seems to me that these higher lows, as often is, they indicate that the market wants to be okay. Soon is asking what MA line I'm using. The blue one is 50 periods, simple average, and the red one is 20 periods. But you should experiment with other moving averages too. So higher lows often signal that the market wants to go higher. When you get further confirmation by, moving averages crossing here, and then market pushing above a resistance, that's yet another confirmation. And if we combine all this with candlestick analysis, what do we see here? We see lots of momentum, kind of momentum shift. We see 2 downside candles, followed by 1, 2, 3, 4, 5 upside candles. And the last one of them is really strong momentum candle closing above these highs. So what should you expect after this? Higher prices, yes. Not only because of these candles, but because of the picture that we built here. Maybe the market is excuse me, maybe the market is reversing higher, reversing the down move and ready to move higher. So we do have a trade opportunity here. The market retraces back to the level, creates what? It creates hammer candles, followed by a momentum candle. It's a small momentum candle, but it's still a momentum candle because it closes at the higher end of its range. And what happens after that? What happens after this is that after a couple of candles, we get another momentum candle. And remember, it's promising higher prices. And we still there's still momentum going on. And remember something, actually, this is a good point to remind you about this. We don't have to understand every candle and every setup there is in the market. We just need to understand and remember setups like this. When lots of things come together, we can either buy when the market retraces to support, or we can buy when there is a momentum candle, another momentum candle, or we can buy when there is a retracement. Oops, sorry. Eventually there is a retracement, but then we are, in this occasion, fairly close to market moving lower. But at the time, we don't know that. When the market has retraced a couple of candles, we don't know that. If we bought that, we were happy until the market moved like this. But, that's something that happens all the time. You just have to have your risk management rules in place so that you never risk too much per trade. So there was no demand, and now we have momentum to the downside. And the market moves surprisingly back to the same level as before. Starts to move sideways around the same level. So people are taking profits. So that's a good reminder that you need to pay attention to previous supports and resistances. And now what's happening with the market, it's kind of hesitating here. It doesn't know exactly what it's doing. It's trying to reverse higher from this support. It penetrated the support for a little while, and it's trying to move higher. But obviously, today is the FOMC day, so we probably won't get the big moves before the market knows what the Fed is going to do and what it signals it's going to do in the near-term future. And something else I should mention here too. When you see the market moving like this and then moving sideways, it's kind of the opposite of what happens here. Market moves higher, moves sideways. That's often followed by another move higher. Then we have a momentum move down, sideways move. That's often followed by a momentum move lower. And if you see candles making like there is a shooting star candle followed by a momentum candle, that's a very good signal that the market is going to continue the earlier move that there was. So you might want to keep your eyes open for something like this. Okay, one more example, because we've spent here almost an hour now. Let's go to Dow Jones. This is the Dow Jones Industrial Average. Very, very popular trading instrument. And if you see something like this, where you have strong momentum to the upside, and then a sharp reversal, you might actually, if it was here, you might start to think that maybe the market is going to come all the way down. maybe it comes down to these lows here. And obviously the reason being that you have a momentum candle and another momentum candle, but there's also a wick here. So this isn't as clear momentum candle as the previous one. But see what happens after this. We get a tiny loss of momentum candle and another one. And when the market takes off, it really does it after this candle. So we have momentum retracement, and then the market signals that this might be just a retracement. And if we use Fibonacci levels, let's see if they can help us here. This is 38.2. So when we see market doing something like this, and we have stochastics at oversold levels, there is a risk that the market moves higher. And if people are shorting here all the time, their stops get triggered somewhere up here. Oops, now this wasn't, sorry. I need to find the spot where I was. Sorry guys, there. So that's where those stops get triggered and the market moves higher quite sharply. So situations like this, they are more challenging. But again, the market gave you a hint that the momentum is shifting here. Or you could say that the original momentum to the upside is about to return. So there we go. Market moved higher. Then came a retracement and sideways movement. Here we have hesitation. The market really doesn't know where it's going. And then whenever you have something like this, you have a range. And now it's the range that defines, let me see there. Now it's the range that defines where the market's going. Market stays in a range, so it really doesn't know what to do. When you had a move higher, that was signifying we had lots of upside momentum. So we might get another push higher. But if you are in a range like this, how do you trade this? You trade it like a range. You buy low, sell high until you see what's happening with the market. Okay, then there was a push to the downside on this candle here, but that was rejected. So that's indicating that the market wants to go higher. And the market is testing the upper end of the range. Now you can see momentum loss there. Some people think that, okay, now's the time to sell because the market is at the resistance. So we have to be ready we have to have a strategy in mind just in case. We have to have a strategy in mind for the short side just in case the market decides to roll over. Now it doesn't. The market moves higher, so the bulls are making money for a moment. And here we have a good example of a fake breakout. But you know what? If you follow the market and if you catch some of these bigger moves, you probably make 4 or 5 times more here than you are losing in these difficult situations. And believe me, they will be there. We get these. We always have to sort of include it in our trading plan that these difficult trade setups will happen every now and then. And we do have to now sort of take these bigger moves in order to pay for the losses that are evident. they evidently come. Okay. Our settings for the oscillator down here, that's stochastics 5, 3, and 3. Ernest is asking about this. So that's percentage K is 5, percentage D is 3, and there is the smoothing setting, or like MetaTrader calls it a slowing setting, it's 3. Stochastics 5, 3, and 3. You can go and add it to your chart by going Insert, Indicators, Oscillators, and Stochastics is here. So that's part of the sort of every MetaTrader package you can find in there. All right, guys, I think we have covered all the stuff that we had for today. So thank you so much. But before you go, I'd love to know how you rate this webinar on scale 1 to 5, 1 being really bad, 5 being the best. How would you rate this webinar? Was it useful to you? Did you learn new things? Was I able to explain the material in such a way that you understood, and now you can take it into your trading, or at least so that you can go and study more and see if this works? You know, you should always use the historical charts and see how often and how well something like this works. Okay, Peter, thank you. Peter's giving me a good number there. I don't want to influence the others. Just before I tell you guys what Peter gave me, maybe you can give me your grade as well on a scale of 1 to 5. What do you think? Was it good or bad or average? Thank you, McHenry. Thank you, Luke. Luvani, thank you. Luvani is saying that the explanation is very understandable. Excellent. I'm happy. Very good. I guess, you know, my time would be wasted if I wasn't able to help you guys, and I love helping you. So excellent. I'm very happy I'm getting 4s and 5s. So very nice. Thank you. And please send me emails. Please send me your questions via email, or give me feedback via email. It's highly important that I get the feedback, because then I get other ideas on, you know, how to create webinars for you. And really, if you like the webinars, share these links when you get the recordings, and when you get the webinar invitations, share those with your friends so that we get big crowds. Lovely. Thank you, guys. So I was getting 5s from Peter, 4 from Edward, and everything else between. I'm very happy.